since last week. We note the potential for slight volatility in the gold market, as market participants may be eagerly awaiting the US employment data, which is due to be released later in the week. In this report, we aim to shed light on the catalysts driving gold's price and assess the future outlook. The US government, for a second time in a year, has barely avoided a government shutdown on the 11th hour as House Speaker McCarthy pushed forth the bipartisan Senate proposed bill, despite opposition from some members in his own political party. The agreement has averted a US government shutdown for the next 47 days, providing the US House of Representatives and the Senate a grace period, in which then they need to reach an agreement to expand the US government funding in order to avoid a shutdown. However, for now the crisis has been averted, and as such, with the lack of a government shutdown which may have resulted in a significant economic deterioration in the US economy, the dollar appears to have regained some bullish momentum during today's trading session. As a result, the dollar's slight strengthening may have aided to the descent of the precious metal, and as the two are considered to be inversely correlated. We would also like to highlight the release of the employment report for September due out this Friday, which will give a status update on the health of the US labor market force, and the Fed officials may be looking closely, assessing whether the expected loosening of the labor market occurs, or if it remains resilient. The tightness of the employment market may allow the Fed to maintain the current interest rates, or perhaps to even hike rates, where a looser labor market could lead to a more dovish stance by the Fed. According to forecasts, the non-farm payrolls figure is expected to drop to 163K compared to the outstanding 187K figure of the previous month. The unemployment rate is expected to drop to 3.7% compared to last month's rate of 3.8%, and the month-on-month average earnings figure is expected to increase to 0.3% when compared to the 0.2% of the previous month. So if the actual rates meet the expectation, we may see the dollar coming under pressures, as the figures indicate loosening of the tightness of the US labor force. However, the slight increase of the average hourly earnings rate might give the Fed justification to maintain their slightly hawkish rhetoric of maintaining interest rates at their current levels for a prolonged period of time. On the other hand, should the average hourly earnings rate come in lower than expected, in addition to the unemployment rate ticking upwards, we may see the Fed in a weaker position to justify the current interest rate levels, which could weigh on the dollar. Also of material importance are the weekly initial jobless claims figure released a day prior to the employment reports of Friday. The US 10-year Treasury bond yields remain elevated near levels that were last seen in 2007. As market participants are anticipating that the current interest rate levels are here to stay for a prolonged period of time. The current levels may be appealing to investors compared to gold, given the US bond yields are interest-bearing and as such could generate a greater level of return to market participants, whereas the precious metal, which is not interest-bearing, may be less appealing to investors. Therefore, the US bond yields are considered to be an alternative investment to the precious metal. As such, the continued ascent of the 10-year US bond yields could weigh on the precious, as they are considered to be inversely correlated. Thank you for watching.